Good evening. Yesterday I told you about CCMA introduction, that is cost control and management accounting. And I told you about management accounting and after that the various techniques to control the cost. Now today I am going to take into account the marginal cost, that is first technique. When you go for marginal cost, one thing you have to keep in memory is margin means additional. That is one more. So marginal cost, what is the additional cost that we come across? Okay, the quantity, when the aggregate total cost, when it changes by increasing the quantity of the product by one more unit or by decreasing, what is the effect on the total cost or the aggregate cost? Okay, when you take into account, okay, the, the additional cost or the aggregate cost, it will change by introducing one more unit or by decreasing one more unit. That one more additional cost, whatever we come across, by either by increasing or by decreasing, it is known as marginal cost. This is one of the important technique that we come across to control the cost. Okay. Now, every businessman, first of all, what he has to do is before getting super profits and abnormal profits, whatever it may be, he has to take into account what is the cost and what is the price. Whether the cost is equivalent to the price or not, he has to look after. And when that cost and when the price, when they are equal, then we can say that point is nothing but no profit, no loss point. Okay, no profit, no loss point. And the same thing, it is known as break even point. Break even point. Mind it, one to two times I'm repeating. Okay, break even point. For studying this break even point, marginal cost is very, very useful. Okay, when you take into account the total cost, total cost you will derive by adding the fixed cost and variable cost. That is nothing but total cost. And how you come across the profits, sir? When sales are more than total cost, automatically the result will be profit. When total cost is more than sales, the difference is nothing but loss. So here what the business people they will try is, okay, they will try to get no profit, no loss point. Okay, no profit, no loss point means at that point, there won't be any profit or loss. That is equilibrium stage. That is whatever you spent, you will receive that much. So there you won't get any profit amount or loss amount. This is how you will come across. And that break even point or no profit no loss point you will derive when you go for marginal costing. And with this help of marginal costing only, people they can be in a position to know whether to reduce the cost or to increase the sales. Okay, anything you can do. When you reduce the cost, automatically you will increase the profit. When you increase the sales, then also you are going to get the profit. So break even point is the point where you won't the business people they won't get either profit nor loss. This is what you have to understand. Okay, so marginal cost. What is this marginal cost? If the additional cost which alters the aggregate cost by increasing one unit or by decreasing one unit. Okay, so that is nothing but marginal cost. When you go for marginal cost, first of all, you have to see how you will come across profit or loss. As I told you earlier, when you add fixed cost and variable cost, you are going to get the total cost. Sales minus total cost is equal to profit. If total cost is more than sales, it is nothing but loss. So the marginal cost equation is, Okay, S minus VC is equal to FC plus P is equal to FC plus C. So what is S? S stands for sales. Variable cost. So when you produce one more unit, okay, the total the fixed cost won't change. It is fixed in nature. Fixed cost is that cost. It is compulsory that we have to bear whether you produce a commodity or you won't produce a commodity. So fixed cost is fixed. And what is the other cost that we are having? Variable cost. By increasing one more unit of product, some costs, some expenses will increase. That expenses which will change or which increases, we will call them as variable cost. So fixed cost plus variable cost is equal to total cost. So S minus VC, that is VC is equal to changeable cost. So S minus VC is equal to FC plus profit. Profit is the amount that we derive. Profit is the amount that we derive. So marginal cost equation is equal to S minus VC is equal to FC plus P. S minus VC, what we will derive? S minus sales minus variable cost is nothing but contribution. The same contribution you will get when you add fixed cost and profit. So that's why the marginal cost equation is equal to sales minus VC is equal to FC plus P. P stands for profit, or FC minus loss. If it is profit, we have to add. If it is my loss, we have to deduct. That is the marginal cost equation. Now, coming to this BEP, break even point. So, we can find out the break even point in units as well as in value. Okay, BEP is equal to fixed cost by, fixed cost by sales minus variable cost. That is, we have to divide the fixed cost with the contribution. Okay, then automatically you are going to get the BEP in units. In units, mind it. Okay, so fixed cost by contribution. Okay, when contribution is more than fixed cost, I told you that, or we come to know that there is profit. Okay, now what we are going to do is we have to find out the BEP. Okay, how to find out the BEP in units as well as in value. We have to see that. Okay, and there are some formulae, okay, to find out the BEP in units as well as in value. So what are the formulas that we come across for calculating BEP? We have to see now. I told you about this marginal cost equation. Okay, profit is equal to sales minus fixed cost plus VC. Profit is equal to sales minus fixed cost minus variable cost, or fixed cost plus profit is equal to sales minus variable cost. So that is the formula to calculate marginal costing equation. And okay, marginal costing equation. Now contribution. So what is this contribution, sir? Sales minus variable cost is equal to contribution. So the contribution should be more than fixed cost. When contribution is more than fixed cost, then only then you are going to get the profit. Suppose if fixed cost is more than contribution, you are going to get the loss. So contribution is nothing but the difference between sales and variable cost. Since sales and variable costs can both be expressed in units, as the contribution is usually expressed in units only, contribution per unit is equal to selling price per unit minus variable cost per unit. Okay, you can also find this contribution in the form of value. Contribution, total contribution is equal to contribution per unit into number of units. That is one formula. The second formula is equal to Total contribution is equal to total sales minus total variable cost. This is the second formula. And another thing is you have to find out the PV ratio. So what is this PV ratio? PV ratio is nothing but profit volume ratio. Okay, at what volume of production, okay, we are going to get the profit. So that is nothing but PV ratio, or in other words, it is nothing but the relationship between contribution and sales. Contribution and sales. PV ratio we have to express in terms of percentage only. So PV ratio is equal to contribution by sales into 100. Contribution by sales into 100, or sales minus variable cost by sales into 100. Anything is one and the same. Contribution by sales or sales minus variable cost by sales is the same. Okay, that is PV ratio. Okay, next, fixed cost plus profit by sales is equal to, that is another formula. Fixed cost plus profit by sales is also contribution, or 1 minus variable cost by sales is also the formula for calculation of PV ratio. Next, change in contribution by change in sales is also the formula for PV ratio. Okay, now we are going for BEP, break even point. Break even point can be expressed, I told you that break even point can be expressed in either in units or in value. So when you go for break even point, that is no profit no loss point. Break even point is also known as no profit no loss point. So when you want to find out break even point in terms of units, fixed cost by contribution per unit, that is one formula. Fixed cost by contribution per unit, or fixed cost by selling price per unit minus variable cost per unit. This is also one formula. So fixed cost into total sales by total sales minus total variable cost is also one formula. Fixed cost by PV ratio is equal to fixed cost into total sales by total contribution is also one formula. Now, when you want to find out, okay, desired profit, that is at this sales, what is the profit that I am going to get? Okay, that is nothing but units for desired profits. Fixed cost plus desired profit by contribution per unit. That is, you will come across the desired profits. Sales for desired profits. So at what sales you are going to get the profit amount, desired profit amount or required profit amount. For that, fixed cost plus desired profits by PV ratio, that is equal to units for desired profit into selling price per unit. There are so many formulas to calculate the break even point, and basing upon the break even point we can see the marginal costing. Okay, and this is one of the important technique to control the costs. Okay, so with this I am going to stop, and tomorrow I am going to continue the remaining portion, that is cash break even point, composite break even point, margin of safety, cost break even point, everything tomorrow I'm going to see. Okay, until then, have a nice day, and please subscribe to my channel if you like this. Please like this and subscribe to my channel. Thank you.